Hey traders, I've been getting a lot of questions about rolling options, when's the best time to roll them, or how to even go about rolling an option. So that's what this video is going to be about. You can see I have a quote at the bottom, keep on rolling baby. I'm not sure if you guys remember the band from the late 90s, Limp Bizkit, but they had a song called Rollin', and at the very beginning, their singer Fred Durst says keep on rolling baby. And for some reason that always sticks in my head. Anytime I'm talking about rolling options or when I go to roll my options, that song plays in my head, especially the main hook of the song where it just keeps saying over and over again, keep rolling, rolling, rolling. So anyway, I just thought that was kind of funny. And I'm sure if you're familiar with that song now, you're going to be thinking about that every time you roll as well. Just be forewarned that if you do go search for that song on YouTube, it does have some explicit lyrics unless you can find the clean radio version. That's the music video there. I think it's the clean version. I was going to play it, but I didn't want to have to deal with the copyright issues from YouTube. So let's jump right in. So what is rolling? Rolling is the closing of a current option position and simultaneously opening a similar position for the same stock and the same option type, meaning that if it was originally a call, it would still be a call, and if it was a put, it would still be a put, with a different expiration and or strike. Rolling can be done for any option type and strategy, including both buying and selling options, but we are looking at rolling from a selling put standpoint. So when you roll, it can be done any of the following ways. You can roll out to a future expiration into the same strike price that you currently have. You could roll to a future expiration and roll down a strike price. So I have those two highlighted in bold because those are the two that I would typically do. I'm either rolling out to the same strike, or if I can roll down a strike, or more than one strike and still get a credit, I would do that as well. But I'm always rolling to a future expiration. You can also roll to a future expiration and up a strike. I don't normally do that. I can't think of the last time I've rolled up a strike like that into a future expiration. You would only do that if you just all of a sudden became really bullish on the stock and thought it was going to recover quickly and keep going up. You could up the strike price to get even more credit for when the stock recovers. The next one is you can roll in the same expiration down a strike. This doesn't really apply to me because I'm doing shorter durations. So I'm only doing like 7 days to expiration. So I typically would never roll in the same expiration cycle. I'm always rolling to a future expiration. But if you did longer duration expirations, like say 45 days, you could roll in that same expiration week or month and roll down a strike. And vice versa, if you're in the same expiration, that same scenario, you could go up a strike. So if the stock really took off early on into your expiration cycle, let's say you have 45 days and the first week the stock shoots up, you could just roll that put up into a higher strike and get more credit within that same duration. But really, in my case, we're going to focus on those first two because that's typically what I'm doing. So why roll? Rolling allows you to extend duration, giving more time for the trade to be profitable instead of taking a loss. You should only roll if your assumptions about the stock haven't changed. So really, all we're doing when we're rolling is if we come to a situation where the option is about to expire and we're going to take a loss, and whatever our initial assumptions about the stock were, there was some reason we got into that stock, right? Whether it's because of technical analysis or some type of fundamental analysis. If those still hold true, then it makes sense to stay with the stock, waiting for it to recover so you don't have to incur that loss. If your assumptions change, then it would make sense to maybe close that position and take the loss. So I know some traders are against rolling because they look at it from the standpoint of you're sticking with a losing trade, that if you're already losing on it, it doesn't make sense to stick with a loser. And I don't necessarily agree with that based on, again, what I said earlier. If my assumptions haven't changed about the stock, then why would I want to close it out if I think it's going to still eventually go up? So to kind of show you what I mean by that, I came up with 3 scenarios to look at. So scenario 1, let's say we have a stock that's priced at $50. And we go and buy 1,000 shares of that stock at $50. After 1 week, let's say the stock drops to $45, and now we would be at a $5,000 loss on paper. So what would you do in the situation? Would you sell the stock at 45 and take the loss? Or would you wait for the stock to recover, hoping that you would not have to take a loss and eventually get a profit? And I would think most people in the situation would say they're going to hold the stock, especially if it's only been 1 week. And if their assumptions haven't changed about the stock, there's no need to close it out. If you feel like it's going to eventually recover, you may have to wait a few months for that to happen, but you would just stick with the stock and hold it until it recovers. Then let's say in week 2, the stock price drops to 40, and now you're down $10,000. It's the same situation. If nothing has changed about your view of the stock, why would you close it out and take that realized loss? Why not just wait for it to recover? And then let's say in week 3 it goes back up to 45. Now you're only down 5,000. And then in the 4th week it goes back up to 50, and now you're back even again. So I think most people would say when it comes to buying stock, they would typically hold on to that stock even when the stock has moved against them and they are down on the stock, and would take a loss if they were to close it out. Scenario 2, let's say we also again have a stock at 50, but this time instead of buying the stock, you sell 10 contracts at the 50 strike for 30 days to expiration. So we're doing a longer term put sale here. Let's say in week 1 it drops to 45. Well, now you're also going to be down 5,000, like in the stock example. Technically, it'd be a little more than 5,000 because the 5,000 is just the intrinsic value of the stock. It would be probably a little more than that due to the time value left. But just for this example, I'm just trying to keep it simple and do apples to apples comparison here. But the question would be, if you sold a put that's 30 days and in the first week it drops to 45, are you going to close that position out? Are you going to take that $5,000 loss? Or are you going to wait, knowing that you still have 3 weeks left, in hopes that the stock is going to recover? And my argument again would be, most people would say they're going to wait since they have the time left in that option. And then it's the same scenario. If it drops to 40 in week 2, would you get out, or would you still wait for those last 2 weeks hoping that it recovers? And then in week 3, it goes back up some, and then in week 4, it paid off by waiting because the stock recovered and you did not have to realize a loss. So now let's take the third scenario as the scenario that we would typically be dealing with, or in my case, the way that I trade my puts. I would sell 10 contracts at the $50 strike with only 7 days to expiration. So I'm only doing 1 week. Well, when that week comes to an end, the stock is at 45 and I'm down $5,000 on that option if I were to close it out. And it's about to expire because I only had 7 days. So my only option here would be to close it out, take the $5,000 loss. I could let the stock get assigned to me at 50 if I did not close it out, or I can roll the trade. And like I said earlier, some traders will say that you shouldn't roll the trade because you're just sticking with a loser. But again, in scenario 1 and 2, I would think that same trader would say they would stick with the trade. Well, our scenario 3 is really no different than scenario 2. We're going to give ourselves more time, just like scenario 2 has 30 days. We're going to give ourselves an extra week. So what we do is we roll to week number 2. And by rolling to week number 2, we can keep it at the same strike price of 50. We're just giving us more time for the stock to recover and be right, like in scenario 1 and scenario 2. So when week 2 rolls around, if the stock drops to 40, we're down 10,000. So we would have to close this out and take a $10,000 loss. But again, if our assumption about the stock is still positive, we can roll it to week 3. And in week 3, if the stock goes back up to 45, we're only down now 5,000. And then we can roll that to week 4. And week 4 it goes back up to 50. And we didn't take a loss. So by rolling every single week, we basically have the same results as scenario 1 and scenario 2. So in my mind, that's why I'm a fan of rolling, because if I was in a situation where I had scenario 2 and I would not close it out for a loss, then why would I want to close out my 7-day one as a loss if I still think the stock is going to eventually recover? Now, the one thing that's not factored into this is obviously your buying power requirement will continue to go up as the stock drops. So that's another piece of this puzzle, is that, if you buy just the stock, you can hold on to that forever and you're not going to have any additional buying power if you're trading, cash secured. But with these puts, as the stock continues to drop, your buying power will go up as well. So that's why it's important, if you watched my previous videos about, what's the risk of being able to make sure you're not extending your buying power. So when you do roll to this week 3 and the stock drops down to 40, do you still have enough buying power to be able to handle a $10,000 loss at that point? Again, that's a paper loss, not a realized loss, because we're rolling these waiting for it to recover. So I would say that's the one downside or the one risk to rolling, is that the roll itself doesn't require more buying power. Like when I roll from week 2 to week 3, my buying power doesn't go up if the stock is staying the same. But if the stock continues to drop as I roll, my buying power will continue to go up. And that's another reason why I always try to roll down a strike to help get myself eventually out of the money so that my buying power doesn't continue to increase. So I hope that makes sense of why I'm showing this, just to give you an idea of why I think at least rolling is something that's beneficial and allows you to stick with the trade and hopefully wait for it to recover. Now, we talked about, your assumptions changing on a stock, and if the assumption changes, you may want to take the loss. And I'm going to give you an example where I've done that recently, earlier this year. So I want to show you my Delta trade that I was trading earlier this year. If you've seen in my previous videos from last year and the year before, I was trading airline stocks a good bit. So I was continuing to sell Delta puts earlier this year. It was one of the few positions I had because I think I mentioned to you guys in January I'd switched over to selling more call spreads, but I did have a couple short puts on, and Delta was one of them. And you can see that I had started out on January the 14th selling the 61 strike put, and then over the next few weeks I rolled Delta to where you can see eventually I rolled it down to the 59.50 strike. And here's what I want to show you guys. So you can see on 226 I had a close order. This was not a roll. I closed it, all my contracts, for $9.49. I have 10 contracts. That was $9,490 that I closed it for. So minus however many credits that I received here, I took almost about a $9,000 loss on Delta because my assumptions about the stock were no longer positive. Because if we look at a chart, so again, I started on January the 14th and closed on 226. So I was trading it up in this range over here. And then you can see as it continued to drop on 226, which would have been right about here, the stock was, around 50. So this is at this point, about 10 points below my strike price. And obviously at this point, the news had come out about coronavirus and travel was getting affected. And I just was not comfortable holding the stock anymore because I could see that there was more downside, and I would rather take that $9,000 loss instead of holding on to it, trying to keep rolling and eventually lose more money. Because if I would have kept rolling, I would have eventually had a margin call. And this comes back to that video again about what's the risk with selling puts, is that at some point, as it gets so deep in the money, you're no longer going to have the buying power left to hold on to the stock, and you'd be forced to close out the position eventually. So if I'd have been forced to close this out, say, when it was at 30, that would have been a pretty significant loss. That would have been about, potentially a $30,000 loss if I would have waited until it got down to 30. And also keep in mind, in 2018, if you remember from one of the other videos, I had a 100% year that year. So I had some profits from 2018 that, essentially I could give back to the market, which is what I did. So I gave back $9,000 of my 2018 profits to the market, still having some profits left over from 2018. Not to mention the fact that, obviously based on my trading results from the last few months, I've recovered that $9,000 and then some, right? It's because I had like an $8,000 month in May, and June was a really good month, around $6,000. So I've already recovered that loss. But I'm just giving you an example here where, rolling doesn't have to be, an all the time strategy. You have to consider the situation. You have to consider what's going on in the stock you're in. You have to consider what's going on in the overall market. And in this situation, this is one of probably a handful of times, I could probably count on both hands the number of times I've closed a position for a loss. And this is the one time that I did it because I no longer felt comfortable holding this stock. And in the day, it benefited me by doing that, even though it was a pretty big loss. It resulted in about a 20% hit to my account. So that one trade knocked my account down by about 20%. But again, like I said, I've recovered it. Now, this stock was one that got hit really hard. I know traders, though, that were able to survive the drop in their positions because, one, they were using a low percentage of their buying power, and two, the stocks have recovered since the recent rally. So, for example, if we look at Apple, I know a trader who was selling puts when Apple was up in this range here, right before the drop. So when Apple was around 325, and they were able to keep rolling their trades even when Apple got all the way down to 220. They had enough buying power left to keep rolling that trade and sticking with it until it eventually recovered back up to their strike price, and they were able to eventually get out. So, Apple's a good example of a stock that would have worked if you were trading that stock during the crash. Again, in my case, Delta was just unfortunately one of the stocks that got hit the hardest and was not one that I probably would have been able to continue rolling. Well, there's no doubt about it. I would not have been able to. It would have eventually forced me to close it out and take a bigger loss. Then I have another friend who is still rolling Lyft. She was trading Lyft again right before the drop. I think she sold puts around the 50 strike level. she was able to hold on to that and roll it all the way down, even when it was down to 14. So her buying power increased, a good bit, like probably 3 or 4 times what the initial buying power was. But she was able to, since again, it wasn't the only position in her account, so she had enough buying power to maintain it and keep rolling, and she's still rolling to this day because it's back up to 30. So she still needs it to go up another 20 points for it to for her to get out of it. But she's got enough buying power to where she could stick with it. So again, just driving home the point that you don't always have to roll. Just be smart about your positions, and if you feel uncomfortable rolling it, it may be a significant loss, but sometimes you just have to take it and move on to a different trade or sit out and wait to get back into the market when you think things have settled down. If we go back and look at my Delta trade, you can see I closed it on 226. I got back into it again thinking that, okay, maybe I'll give it one more try. But you can see I got nervous because I got in again on 226. I sold the 46.50 put. And then the next day I closed it out for a small loss. And I was like, you know what? I can't deal with this anymore. I'm not going to even bother trading this. And I went to completely in cash. I've mentioned it in another video. I went to completely in cash in the end of February. And you can see I did not start trading again until April 8th. And I actually started trading Delta again at the 22 strike price. I mean, look at the difference. I was trading it, at 60, and now here I am trading it again at 22. So I did start trading Delta again a little bit once I started back trading. And, that saved me a lot of money by moving to cash and just waiting for things to settle down and waiting for the market to recover. So now I'll show you real quick in the desktop how you would execute a roll. I've shown this before, but I'll show it again real quick. This may vary from broker to broker, but this is how I would do it with my broker. So anytime you want to roll in the desktop app, you would go to the Monitor, Activity, and Positions tab. You'd find the position you want to roll. In this case, let's look at GOOS. I would have to open it up and then find the option. In this case, it's the July 17, 2045, 24.5 put. I would right click on it. It gives me the option to close it. So I could actually close this trade out and be done with it if I want to take a loss, but it would cost me $2,670 to do it because I have 10 contracts. Or I can do create rolling order. And that's what it's showing me here. It calls it a calendar. You don't have to worry about the naming convention. It's just because technically this is a calendar from an option strategy standpoint, but we just call it rolling. Okay, so when we're doing a roll, we're closing our current position, which is this July 17th, 24.5 put, and we're rolling it to a future expiration. In this case, it defaults it to the following week, which is July 24th, to the same strike price. But based on that earlier slide that we looked at, we can change the expiration or the strike price or both, just depending on what we're trying to accomplish. So if I wanted to roll it further than just 1 week, I could change the expiration to, say, August 7th. And you can see I'm going to get a bigger credit for that because the further out I roll it, the more credit it's going to give me. Similarly, I could try to roll it down to strike price. So I could change the 24.5 to 24. And you can see I'm still going to get a credit. So maybe I would look at the 23.50. And I still get a credit. So maybe that would be the strike price I would select and the expiration I go with. If I want to do a closer expiration, let's say the 24th, obviously I can't roll down a strike and still get a credit. So I'd have to keep it at the 24.5 strike to still get a credit. So those are things you have to decide, are you comfortable leaving it at the same strike price so that you can roll it to a closer expiration, hoping that it will recover and you'll be out of this in a week? Or if you want to try to get it down to strike price, you're going to have to extend that maybe 3 or 4 weeks out so that you could keep it at the same strike price and get a big credit. We could get $1 credit here, but if you want to try to get it lower down to the 23, we can get a small credit and get a nice roll down to try to get our strike back out of the money. So it's really just a personal preference. I mean, obviously, I always like to try to roll it down so I can get out quicker. But the downside to going out to August 14th is that, let's say the stock shoots up and recovers back above 24.5. If I would have kept it at that strike for just 1 week, I could have closed it out and be done with it. But since I've got to August 14th, I'm going to have to hold it a lot longer to be able to close that out and get a profit just because I've extended my duration, out 3 or 4 weeks. So the benefit of doing this is that it executes this simultaneously. Your broker may be different. It may not even have an option to do rolling. You can execute a roll manually. You can do these as two separate trades where you close out one trade and open a new one. But the nice thing about being able to do it as one trade, because you already get to see what the net difference is on your credit. We don't really care how much it's going to cost to buy this one back and how much we're going to get for the credit for the next week. We just want to make sure that the net credit, the difference between these two, is going to be a positive credit. But if you did not have the ability to do a roll simultaneously as one trade, what you would have to do is go back to your trade in your broker platform. You would right click, create closing order, and you would buy to close that option for 2.67. Now it's important to remember that number, because this is how much you're losing at this point by closing this out. You're gonna have to spend $2,670 to close it out. So when you go sell your new put, you want to make sure you're collecting at least that amount to make it to where you're not losing any money. Now when you go to close the trade, you can see that it has a pretty big range as far as the bid and ask goes. So the ask on this would be 2.67, but the mid price is 2.34. So obviously I'm going to try to get the best price possible. So I would move this down to 2.34 and try to get a fill at that price. But whatever price I get filled at, I need to make sure that the next trade I put on, I'm going to, again, get that amount or higher. So let's just assume I can get filled at 2.34 to close this out. Then when I go look at my new trade, I want to look at the week after. So I want to look at July 24th. And if we stay with the same strike price, which is the 24.50, we closed it out for 2.34. Again, assuming we could get filled at the mid price. So when I get into this trade, I want to at least try to get that amount. So if I hit to sell a put at the bid, you can see it's 220. I want to try to get at least 234. In this case, I'll do 235, which would mean I'd have a 1 cent net credit, and then I would execute this trade, and hopefully I can get that fill. If not, I may have to lower it and take a small loss if I get filled below the price that I closed out my other trade, or I could push it out another week. And see, pushing out to July 31st, I'm going to get a better fill because the bid right now is at 2.35. So I know I could get that price, which would cover the loss that I took from closing out that other trade. So this is kind of the downside to manually doing this, because the stock is going to be continuing to move up and down while you're trying to execute these trades. So it could be that while you're trying to put on this new trade, the stock could have already went up some, which would make it to where you're not going to get a very good credit to offset the option you just closed out. So ideally, you always want to do this as one trade, but I'm just showing you this can be done manually if you need to. There are situations where I have to do it manually because if it's really deep in the money, I may not be able to get a good feel by doing it as one transaction, but I can get a better feel if I do them as a separate transaction. So I would go ahead and close it out and try to really negotiate my price between the bid and the ask, and then hurry up and come in and put on this new trade, again, trying to execute it quickly before the stock really moves that could affect my entry price. So the next question I get is, when is the best time to roll? So I'm not sure if you're familiar with the terms intrinsic value and extrinsic value. Intrinsic value basically just means what's the true value of the option. An option doesn't have any intrinsic value until the option becomes in the money. So you can see on our put side, all these strike prices that are out of the money, because I'm looking at Uber right now, it's at 33.14. All the strike prices below 33.14 have an intrinsic value of 0. All the strike prices that are in the money have an intrinsic value. The extrinsic value of an option is the time value. That's the part of the option that will eventually decay to 0. The intrinsic value will always remain the same. Just to clarify, when I say the intrinsic value always remains the same, I mean it doesn't decay. It will stay the same if the stock doesn't move, but the extrinsic value will eventually go to 0. So the intrinsic value will change with the movement of the stock, but it will always equal the amount the stock is in the money. And also the intrinsic value is the same regardless of what option chain you look at. Right now we're looking at July 24th. You can see this 33.50 strike price is at 36 cents. If I look at the next week, it's also going to be 36 cents. And if you were to compare every single strike price, the intrinsic value is going to be the same regardless of what week you look at, regardless of how far out you go. So what that tells us is if that remains the same for each expiration period, really and truly, the part that we want to look at is the extrinsic value. That's the part that's going to change, and that's the part that's going to affect how big our credit's going to be when we roll. So if you look at the extrinsic value, one thing you'll notice is that the extrinsic value is the highest at the strike price that's at the money. So this 33 strike price, technically it's slightly out of the money, but it's the closest strike price to the stock. We would consider this to be the at the money strike price. And you can see it has the highest extrinsic value out of all the other strike prices. As we move further out of the money, you can see the extrinsic value keeps dropping to where if we get a strike price that's really far out of the money, we're going to get down to where the option is basically worth nothing. The extrinsic value is only worth 3 cents. But interestingly enough, the same thing happens when you move in the money. So the deeper in the money we go, you can see that the extrinsic value also decreases to where when we get really deep in the money, at this 40.5 strike, you can see the extrinsic value is only 0.01, which means that if you had the 40.5 strike and you tried to roll it, there's really not a lot of credit that's going to be there because the extrinsic value is already going to be the same. It's going to be at 736 to whatever week you roll it to. So you can only profit off of the extrinsic value, which is going to be very small. Even if we go look at the next week at the 40.50 strike, so you can see the extrinsic value is a little bit better. It's not 1 penny, it's 19 cents. But again, as you get further and further here, you're also going to get to where eventually the extrinsic value is going to drop a lot lower. So what does that tell us? So basically, the best time to roll an option when you're going to get the biggest bang for your buck, so to speak, where you're going to get the most credit when you roll, is to roll when the stock hits your strike price, when the stock is at the money. So if you had sold a 33 strike put and the stock dropped to 33, that is the best time to roll because that's when you're going to get the most extrinsic value when you roll your option. So I put together this spreadsheet to hopefully maybe explain this a little better. So this is Uber, again, the one we were just looking at. Here's the strike prices. Here's the trading price for the options for the week of July 17th. And here's the trading prices for the week of July 24th. And here's the amount that the option would be in the money based on the stock being at 33.14. So for example, if you sold a 36.5 strike, you're going to be 3.36 in the money. When you roll this, if you keep it the same strike, meaning that you roll from July 17th to July 24th and you keep the strike at 36.5, you're only going to get a 0.27 credit. I say only. I mean, that's a pretty good credit to get for rolling a strike price that is 3 points in the money. But you can see that if you had the 33.5 strike and you rolled it right when the stock got around 33.5, you'd have gotten a 48-cent credit. So you can see that the credit's a lot better when you roll it when the strike price is close to the stock price versus when it's deeper in the money. You can see the deeper in the money we get, the less and less credit we're going to get. So this 36.5 strike price, when it was considered at the money, it would have paid roughly 48 cents as well. It would have been more than what you see here, again, because it would have been at the money. So then let's look at what if we want to try to roll down a strike, right? Let's say I want to be able, if I have the 36.5 strike, I want to be able to roll it down to 36. Well, if I do, if I wait to roll to when the stock is already 3 points in the money, it's going to cost me 12 cents to be able to roll down a strike. I'd have to pay a debit. You can see for this one, if we wait until the stock is at, almost 3 points in the money, we still couldn't roll down a strike. It would cost us 6 cents to roll. But if we rolled it when the stock was at the money, we could roll down a strike and still get a credit of 22 cents. And then if we do a 2-strike roll, you can see that a 2-strike roll, there was no situation where we could roll down 2 strike prices and get a credit except for the at the money strike. Technically, it was a small debit. It's minus 0.005. That's pretty much basically even. That would have cost you, just a few dollars to do that. So it technically is still a debit, but I would consider that pretty much, a roll at no cost. So the dilemma here is, let's say it's a Monday and you sold the 33.5 strike price expiring that Friday, and the stock drops to 33.14 on Monday. Well, you know that this is the optimum time to roll. You're going to get the best credit possible to roll it, and you're probably going to be able to roll it down a strike or two if you roll it on Monday. But it's so close to the strike price, you also may want to wait until Friday, hoping that it will recover above the 33.5 strike price, and you can just close it out. Because if you roll this on Monday, let's say you roll it down 2 strike prices, so you roll it down to the 32.50, and by Friday it recovers above 33.50, you're going to be kicking yourself because now you have another week you have to stay in the stock, waiting for it to stay above 32.5 the following week. And maybe it won't. Maybe the week after it drops down below 32.5, and now you're having to keep roll it. So that's the dilemma, is deciding, do you want to capitalize on getting the most credit, or are you okay waiting, realizing that if the stock does continue to drop, and let's say it drops to where it's 3 points in the money, where maybe it drops down to the 30.5 strike, based on this that you will not be able to roll it down a strike price. You'll have to stick with the same strike price. You'll have to still roll it for the same strike price you had, and you'll get a smaller credit than what you would have gotten if you'd have rolled it on the Monday. And that's just something that you have to decide for yourself. Sometimes I will go ahead and roll it on that Monday, especially if I can really drop it 2 or 3 strike prices. I may go ahead and do that. And then if at the end of the week it recovers, and oh well, I'm stuck holding the stock longer. But sometimes I won't. If it's really close to my strike price, and maybe it's Wednesday or Thursday, and there's only 1 or 2 days left to go, I'll hold out and wait to see and take that risk. I know I'm going to get a credit regardless. I know I'm going to get a credit when I roll because the future expiration will have a higher extrinsic value. So it just may mean that by waiting, I'm going to miss out on a better credit or miss out being able to drop my strike price. I'm going to be stuck taking a smaller credit, and that may be worth kind of taking that chance, hoping that the stock will recover above my strike price. So at the end of the day, if you want to be mechanical about it, you have, I think, 2 options. Either always roll when the stock hits your strike price to get the best credit possible and to be able to roll down a strike or 2 if you want to, or just always wait till Friday, realizing that if the stock continues to drop 3 or 4 points below your strike price, that when you do eventually roll it on that Friday, you're going to get a smaller credit and potentially have to keep it at the same strike price and not be able to roll it down a strike or 2. Those are kind of your 2 choices. It just depends on what I think. If the stock drops to my strike price earlier in the week and I feel like there was no reason for it to drop, maybe it was just because of the overall market took a drop, but I think by the end of the week it could recover, I'll hold out and wait, and I'll be fine with, if it does continue to drop, then oh well, I'm not going to get a great credit on that Friday. Or if it's a situation where I think the stock could continue to drop and I don't want to have to wait until Friday and potentially get a really, really crappy roll or get a roll that's not going to pay much of a credit, then I'll go ahead and roll it on that Monday to get the better credit, to roll it down. If I'm stuck with it for a week or 2 more because of that, then, I'm okay with that. Quickly, I did the same thing for Twitter. The reason why I want to show you this one, as I was keying in the numbers, I noticed that even though, like, for example, this 38.50 strike price was 3 points in the money, you were still getting a really nice credit for the roll. And I was confused, like, why is the credit so good for this? And the reason why, and I pretty much knew what it was before I even looked, is that Twitter's got earnings coming up the week of the 24th. So the extrinsic value in those options are going to be a lot higher because of the implied volatility increase in those options because of an earning event coming up. If we could look at Twitter real quick, you can just tell by the implied volatility for these options. You can see the week of the 17th, it's at 68%, and then the week of the 24th, it jumps to 95%, and then drops back down to 83% the week after. So I clearly knew there was an earnings event coming up just by seeing that. And when I went to look at the earnings calendar, sure enough, I believe Twitter's reporting on July 22nd, which would fall in that expiration week. So that's why the credit was so high, even when rolling down a few strike prices. So why is that important? Well, if you don't like trading earnings, this is something that you need to be aware of, because when you see this, you may think, oh man, this is great. I'm going to get an awesome credit, and I can roll this down 3 or 4 strike prices. And then the week after, earnings comes out, and the earnings are bad, and the stock really tanks and drops, well below the strike price you rolled to. And you may think to yourself, oh, if I knew earnings was coming out, I would not have rolled. So those are things to consider. Anytime you see just some kind of unusual credit that looks really big, that you're not typically seeing when you roll, because typically you know that you can roll down 1 strike or 2 at the most, but the credit's going to be very small. When you start seeing these big credits still, here's a 56-cent credit for a 2-strike roll. You know that some event's coming up that week, and you need to kind of do your own research to figure out what that could be. It may be earnings. It could be some big announcement that's coming out for that particular company, and you need to decide, do you want to risk rolling into that week, realizing the stock could take a big hit if the news turns out to be bad. But the nice thing is, it does allow you to roll your strike way further down. You can see that if you were to roll this when it was at the money, you could roll down 5 strike prices and still get a small credit for that. So it puts you in a safer range even if the stock earnings was bad. So what are the takeaways? So the best time to roll is when the stock touches the strike price. This will give you the highest credit for the roll and a greater chance of being able to lower the strike for a credit. If this occurs earlier in the week, you will have to decide between getting the best credit or holding till expiration in hopes that it is above the strike. So this is what I talked about earlier. If it touches your strike price on a Monday and your expiration is a Friday, you got to make the decision of, do you want to go ahead and roll then to get the best credit possible and possibly roll down a few strike prices? Or do you want to wait until Friday in hopes that the stock goes back above your strike price or stays above the strike price so that you can just close it out and not have to roll at all? That's a decision you have to make for yourself, but that's really your two choices. 99% of the time, you should be able to roll for a credit when keeping the same strike. So even when the stock drops a good bit, maybe you don't have the opportunity to roll it when it hits your strike price. Maybe overnight the stock drops 3 or 4 points below your strike price to where when it opens the next day, there was not even a chance for you to roll it when it hit the strike price. So now it's 3 or 4 points below, and now you're going to have to roll it when it's in the money. You should still always be able to get a credit even when you roll to a strike price that's deep in the money. And the reason for that is, again, because the expiration you're rolling into, whether it's next week or the week after, the extrinsic value of those options is going to be higher than the current week for that same strike price. Now, situations where you may not get a credit, that 1% would be if it's really, really deep in the money, like 10 points below your strike price, to where the bid and ask spread could be really wide and it's hard for you to get a good feel, which is what I showed you earlier about having to sometimes manually go in and do that, where you'd have to try to close out your original position first and then try to get into your new position. That's the only time where you may not get a credit because, again, if the stock moves on you in between, by the time you put the new trade on, you may end up having to pay a small debit to be able to get that roll. But again, 99% of the time, you're going to get a credit if you stick with the same strike price. There are instances where your strike may not be available for a future expiration. That would require rolling to a different strike, possibly resulting in paying a debit. This can be eliminated by rolling further out in time or rolling up a strike. So there are situations where, let's say your strike price was originally the 30 strike price, but for whatever reason, on the options chain for the next week, they don't have a 30 strike price. Maybe it's a 29.5 strike, and then it goes from 29.5 to 30.5. Well, your 30 strike doesn't exist, so you can't roll to that strike. So your only choice would be to roll down to the 29.5, which could result in having to pay a debit, or you could roll up to the 30.5, which would give you a credit, but now the stock has to move even further to get back above your strike price. Or you could roll out to a further expiration. So let's say maybe you roll it out 3 or 4 weeks and then roll it down to that 29.5 strike price so that you can still get a credit. So this doesn't happen all the time, but there are situations where I'll find that my strike price for whatever reason didn't exist in a given week when I try to roll to that week. So I had to pick a different strike price in that situation. If the stock continues to drop after rolling, the margin requirement would increase. So this is, again, I guess kind of the one drawback or downside to rolling is that the roll itself does not require more buying power because think about it, you're staying with the same strike price. If you're buying, whatever your buying power is today at that strike price, it's going to be the same when you roll it to next week for that strike price. But as the stock continues to drop, or if it continues to drop, your buying power is going to continue to go up. And if you keep rolling for several weeks and it keeps dropping, then you could be in a situation where your buying power gets so high you can't afford to keep rolling. You'll have to close out some contracts possibly and take a loss. You may have to close out the entire position for a loss. So that comes back to buying power management and obviously not putting all your buying power into one position. But that's just, again, a call out to know that that is the one risk of rolling. And that, again, that's only if the stock continues to drop. If you roll and the stock maybe drops just a little bit, then your buying power may go up some, but it's not going to go up drastically. Like my GEOS trade, the stock is down, 3 points below my strike price right now, but my buying power has only gone up $100 per contract. When I initially sent out my alert for that trade, I think it was $600 per contract, and now mine is at $700 per contract. So I did 10 contracts, so mine went from 6,000 buying power to 7,000 buying power. So it wasn't a very significant increase, even though the stock is down below my strike price right now. Lastly, rolling to a strike that is in the money could result in early assignment. this should not be of concern. So anytime your stock is in the money, there's always the risk for early assignment. So when you roll, if you roll to a strike price that is still in the money, there's the risk you could be early assigned. It doesn't happen very often. I could probably, count on one hand the number of times I was early assigned last year out of hundreds of trades, but it does happen, and I've talked about in other videos. It's not something to be concerned about. There's ways to fix it, and I'll make another updated video showing how you would fix early assignment. But just know, again, that's something that can still happen, that it typically only happens when the stock really moves deep in the money. If it's only, a point or two below your strike price, the chances of early assignment is very rare. It would only be to when the extrinsic value of that option pretty much goes to zero, where there's very little extrinsic value in that option. Then whoever bought that put may go ahead and early assign it. But I will talk about that in another video. So I hope this wasn't too much information. I mean, I could have really just told you in the very beginning of the video that the best time to roll was when the stock touches the strike price. But I want to try to explain to you the whys behind this, so you're not just taking my word for it, so you can see what the reason is behind this and why it's best to roll when it's at the money, because that's when the extrinsic value is the highest. If you have any questions about this, let me know. Hopefully I've answered all the questions about this that you guys have been emailing me, but if there's something that I did not cover, let me know and I'll do a follow-up video. Thanks.